India has decked out ahead of Independence Day celebrations, and we have a special show on what India is likely to look like 100 years, at 100 years. We've got that special coverage coming to you on ET Now at 9 p.m. tonight. Up first, let's talk about US consumer prices. There, the prices have fallen below 3%. It's happened for the first time since March 2021. And the number that you're looking at on your screens is 2.9%. And this on an annual basis, we are making that comparison. It is definitely lower than what analysts were expecting. That number that they were looking at is 3%, so it's come in lower than that. And the core CPI, which excludes volatile food and energy prices, that has come in at 3.2%, which is also pretty much in line with estimates. President Joe Biden has blamed large corporations for not doing enough to bring down prices. On the back of this, we've seen Wall Street open in the green. And let's bring up what's happening on the indices as far as Wall Street is concerned. I was looking at it just a moment ago, and look at the way the Dow is panning out. 39,790 levels is where we're currently at. So pretty flat at this point in time with a positive bias, but not so for the Nasdaq, which is down by 0.75 percentage point and is now trading around 17,050. The S&P is down by 0.25 point, and now it's trading at 5,420 levels. Let's get perspective on this. Manish Singh, market expert, joining us to break this down for us. Manish, does this kind of data suggest a rate cut by the Fed in September, and does it point at a likely 50 bips cut at that point in time? Because any more than that seems to have been negated by the kind of print that we're looking at.
Hi, Vikram. Good evening. Yes, I mean, it's a good number in the sense that people were expecting this number to be soft or below expectation. And let's remember, we got the PPI number yesterday, which already had given us some indication about, where the CPI number could come. And as you mentioned, this is the first time we have seen a number below 3% since March 2021. So that's a good sign. But we have seen 3% handle for over a year now, right? So we are in this over a year now. We have seen that inflation, headline inflation, has been at 3%. It just tells you that there are some latent things, which keeps the data at 3%. And one of that is housing and shelter. So if you look at the current number, at least on the core side, you have seen that 80% or over 90% of those contributions, monthly increase this month you have seen coming from rents and shelter. Now that is, in my opinion, backward-looking data. So for all purposes, inflation was last year's story, last 12 months story. Jobs and economy is this year's story, which is what Fed should be focused on. And therefore, Fed should feel very comfortable in cutting rate. In my opinion, they should do a 50 basis point cut to show an intent that they're going to avoid a recession if there's one lingering on the sidelines.
5th August kind of slide that we saw in the markets was on the exact fear that you're talking about the economy weakening and the fear of a hard landing as well. So now looking at this inflation print, what do we make of the road ahead where the American economy is concerned and the kind of landing? How is it likely to be?
Vikram, I would say that, I have never been in a hard landing camp. I think that Fed has enough tools at its disposal to manage it. Now, if you see the rates are at 5.25, even if they did an easing by 50 basis points and we get to 4.75, that is by no means an easy rate. There's plenty of headroom to ease more. If an alien came from outside the world and saw rates at 4.75, it would say that the rates are very tight. So I think there's plenty of room for Fed to do that. Now, if you add to that, the GDP growth we are still seeing is at 2%. The huge income generation that you have seen from interest rates staying high, and I'm talking about people who have assets and investments and all, that keeps the consumption still going. The wages are still growing on month-on-month basis. So if you have a job, you're still able to consume and add to consumption. So we are not seeing that hard landing scenario building up. However, at Fed, you have to be wary to act in advance of such a thing building up. And therefore, I think 50 basis point cut will be very good, and that is going to prevent a recession. Because if you look at business confidence, we're not talking about recession at all in business confidence numbers, but just easing rates will prolong and we can avoid a recession and continue with positive GDP growth in the US.
Have perspective on the Indian markets coming through from Ajay Bagga, who's joining us at this point on India Tonight. Welcome to the show, Ajay. Do tell us, from your perspective, the kind of print that we are seeing on American CPI, how is that likely to impact investors in India?
There was hope of some policy stimulus, and
Yes.
the narrative has moved from if to when, and now it is moved to how much. So 25 or 50 basis points in September. That's the trajectory the narrative is taking. As rates are cut, we see a strong correlation with a weaker dollar to emerging market flows picking up further. So expectations are that as rate cuts set in, there would be some more flows coming into emerging markets and into India especially. The good thing of today's number is that if you take the 3 months and the 6 months running averages, those are coming below 2%. Now the Fed has one more CPI print and one more payrolls data coming its way before the 17th and 18th September meeting goes through. So we are expecting a 25 basis point rate cut, and which is normally positive for emerging markets. The big difference this time around, Vikram, is that it's not a rate cut trying to avoid a recession or being a measure in the midst of recession. It's more a mid-cycle, that is coming in, and they're trying to head that off. So it's not a full-blown recession, at least for the next 6 months that we foresee. And so the situation is not grim. I think the Fed will take its time and in terms of cutting rates, but that will set off Asian central banks on the path of rate cuts, and we are expecting RBI to change its policy stance in the October policy, move to neutral, and by December to come back with its first rate cut of this cycle, and to go in for about 75 basis points of rate cuts by about April, May.
What you're saying is that the Fed has breathing room. At this point in time, there is enough of a window for them to act, looking at this kind of inflation print. And they're not staring at recession in their face. But the Asian countries now, as far as their central banks are concerned, including the RBI, could be looking at rate cuts soon. In terms of investor sentiment right now, we're looking at what President Joe Biden has said, Manish, about he's blaming large companies for not doing enough to bring down prices. Of course, a part of this would be kind of considering the kind of rhetoric flying around ahead of the presidential elections. But that's an important moving piece for the markets as well, right? How these elections will pan out.
I agree. I think that, given election is just 2 months away, or less than 2 months away, these things are just going to be bandied about, and which is what he's doing. President Biden likes to blame the businesses, but on the other hand, he claims that he created 15 million jobs. I mean, those are not jobs that he created. Those are jobs that were lost in COVID and came back. So I think one can argue the way he likes to make his point. But in reality, the market does what market has to do, and policymakers have to respond to it. And just as we as market participants have to respond to what policymakers do, instead of blaming each other. The point is that if the rates are not cut and inflation continues to fall, then your real rates are going to be higher. And what is the job of a central banker? They need to raise rates when they see inflation or fear of inflation. And when that has subsided, there's no reason to keep the rates at a very high level. So the basis is very, very clear. And also on growth front, so long as, as I keep saying that, a huge amount of money has gone into US economy by way of deficit spending, they will continue to show up, and those will keep the economy going. And still with rates at 4.75, if we get a 50 basis point, that would still be generating a lot of income for a lot of people. And that will continue the economy going. So as the rates are cut, recession can be avoided, and we can continue this expansion of US growth. And then, of course, we'll see what happens if there's a change in the administration or new policies they bring in. But I am not bearish at all. I think that what we saw last week was just a carry trade tantrum, which has gone away, and you see the market is higher from where it was on last Wednesday.
In fact, I'm also looking at gold prices right now, which are taking a dip because now hopes of a large rate cut seem to have been dashed by this CPI data coming out. So in that sense, when you consider the mood among investors right now in India, because we are talking about foreign investment not having that much of a sway in the Indian markets, but looking at corporate earnings and how they've panned out, Ajay, what do you think about the trajectory of growth in our own markets, whether or not the Fed does cut their rates in September?
Yeah, the trajectory for India is quite strong. Of course, the economy slows down a bit. There is a drag with the high interest rates. Secondly, what's has been impacting the markets is regular FI selling. If you look at the cash number only for this month so far in August, nearly 31,000 crores has gone out in terms of FI selling, nearly 2,000 crores being sold. Only 2 days we have seen a positive print on the FI number. But the good thing is that the flows into the mutual fund and insurance industry are more than compensating this. And so we are not seeing India falling too much, but we are not also rising too fast. So these are sideways markets, and they're looking for a catalyst. So the Fed rate cut could be a small catalyst, but the FI flows have to revive to take the markets up on a very considered manner. The second big point is on the earnings part. So earnings were okay as per expectations, but it was more a ho-hum kind of a quarter. It wasn't a great quarter that markets would get very excited about, because the markets have discounted a lot of the growth. And now the challenge becomes execution on what the valuations are already showing. So, not a cheap market, having discounted multiple years' growth and flows negative from foreign investors, not a very good combination for a fast rise in the market. So, we'll see a steady rise on domestic flows, and it will all depend on some earnings revival, especially on the banking side. There is a lot of worry because deposit rates are going up and the NIMs are compressing. So how does the credit growth on the banking side continue?
Absolutely. Absolutely. I mean, we've been watching the banking stocks, and yes, the sideways movement that you were indicating, that seems to be real as far as our market conditions go, and we'll see what the big trigger is next for the markets. Ajay Bagga and Manish Singh, many thanks for joining us with your perspective on India Tonight.